How's it going, everybody? So in this video, I am going to talk about why do mortgages work in Canada, or sorry, how do mortgages work in Canada? So before I get started, please subscribe to my channel if you haven't already. I do appreciate the support. It helps my channel grow. Please follow me on Instagram, Dylanberg999. So here's the thing with how mortgages work. Mortgages work, all the bank does, what the bank will do is they will ask you for all this information. Like when you fill out a mortgage, I've done 4 mortgage applications already. I'm only 27. I've lived in 4 different houses. I lived in a house since I was 19 with my brother, so bought my first house when I was 19. And yeah, I've just been moving around a little bit lately because we really haven't found the house that we want to be in yet, me and my wife. So the way mortgages work, and it's very, very simple. The bank wants to make money. When they give you a mortgage, they make a ton of money. If you pay that mortgage off in 25 years, the bank, depending on the amount of mortgage, just from the interest rate, or that's how they make their money, is from the interest rate, they'll make anywhere from $100,000 to $200,000 on a decently sized mortgage. So they are making bank. They are making a ton of money. So the bank wants to give you a mortgage. They want to make sure that they give you a mortgage and that you pay that mortgage off. So if the bank is going to say, I don't think this guy's going to be able to pay this mortgage, they're not going to give it to you. But here's the thing, and this is what I don't like. Banks give out mortgages when they shouldn't. What the bank does is they do a debt to service ratio. What this means is you take your income, you and your wife, or you and your girlfriend, or just you, whoever's buying the house, you take your income. You then take your expenses, such as your bills for the month. If you have credit card loans, if you have Visa loans, if you have car payments, I don't know if I said car payments, yeah. And you take all of those things, that is your debt. That's how much you owe. You then take your income. Now, if you divide those two, and if it's less than 40%, they will give you a mortgage. Here's the thing. They want to make sure that you have some stable income. So what they'll do is they'll ask you for 1 to 2 years. Generally, they want to see 2 years of stable income. So they want to make sure, hey, this guy's been at his job for about 2 years. I've been at my job right now for 1.5 years. Actually, I've been there for almost 3 years, but I quit and then came back. So I've only been there for 1.5 years consistently. And the wife's been at her job for about 6 months. She's been in the field for about 6 years, but at her new job for 6 months. Now, we're going to get a mortgage because my down payment is absolutely massive. So our debt to service ratio is 15%. So the guy even filling out our application, he's like, you guys are going to get this mortgage, no problem. So the less your debt to service ratio is, the better your chance of getting that mortgage. If it's sitting at about 40%, they're probably going to give it to you, but they may not. So that's what I mean. I would never do a 30% debt to service ratio, never a 40%. What happens is when they are that high, you are literally putting all your money into your mortgage. And then you become house broke, which means you can afford a house, but you can't afford to do anything else because all your money's going into your house. So that's how mortgages work in Canada. They do a 40% debt to service ratio. They then want to see about 2 years of stable income, and then they'll take all your debt, they'll pile it up. And if you take your income divided by your debt, if it's less than 40%, then you will get a mortgage. So it's pretty simple. End of video. Thank you so much for watching. Please subscribe to my channel if you haven't already. Please follow me on Instagram at Dylanberg999. Also, before I leave, some people say get as big of a mortgage as you can afford. The stupidest thing I've ever heard. I think we're approved for about an $800,000 or $900,000 mortgage. That's how much we could take out if we wanted to. We could afford a house that's $800,000 or $900,000. We're not going to go over 500. So yeah, what the bank recommends or what the bank says your max can be, it's absolutely astonishing, and I would never do it. So end of video. Thank you so much for watching. Please subscribe to my channel if you haven't already. Please follow me on Instagram, Dylanberg999. Thank you.